GBP is one of the most important topics in CA inter income tax paper. Every attempt in the very first question, total income computation question of 15 marks, majority of the adjustments are asked from this PGBP topic only. So it becomes very important to learn this chapter very conceptually and carefully, guys. I will take you through all the concepts of PGBP chapter step by step in a beautiful manner with lot of examples also included in this discussion. So be tuned in this discussion till the end. Don't miss even a single topic in this. So guys, you need to understand what is PGBP actually. PGBP is nothing but we are trying to find out the profit of a business. How do you generally find out a profit of a business? Very simple. You will take sales minus all the expenses, or income minus expenses, we can say. So from income, you will reduce all your expenses, and the net profit is called the ultimate profit, which is of a business. Correct? So on the credit side of your profit and loss account, you will have all your incomes, and on the debit side of your profit and loss accounts, generally you have all the expenses which you claim against the income. And what is the balancing figure is called as the profit from business. That's all. It is as simple as that. So in this chapter, we will be discussing all those incomes which are taxable under the PGBP head, and all those expenses which we can claim under the PGBP head. Once we take income and reduce from that all the expenditures, we will arrive at the business profit, which is taxable under the PGBP head. Now, in this chapter, we will be dealing with multiple sections. See guys, always remember section 28 and section 41 only discuss about the income portion. So I told you there are two things, income and expenditure. Income is dealt with under section 28 and 41. But right from section 30 till section 40A, it will be discussing about the expenditures. But section 30 to 37 discusses about the deductions which we can claim against the income, and section 40 and 40A will discuss about the disallowances. Means these are the expenses which we cannot claim against the income. But in section 29, the method of computation of PGBP is given. What is method? Very simple method. It is just a P&L kind of a format. 29 says that on the credit side, you have to consider section 28 and 41 incomes, and on the debit side, of course, you will claim the expenses under section 30 to 37. I will be taking you through all the sections which are relevant for PGBP concept. First, we will take the section 28, which is income section. So here in section 28, there are list of things which are given has to be considered as income under the PGBP head. Income chargeable under PGBP. What are those? First one, it says any profit or gain from business or profession has to be considered as income, business income. Any profit you get from a business or a profession is taxable as the PGBP income, guys. It may be from, vocation. What is a vocation? Kind of actors or temporary business. You may be doing a permanent business or you may be doing temporary business, does not matter. You are doing business, that's all. Or you are carrying on some profession, and whatever income you have earned, that is taxable under the PGBP head. Any interest, salary, bonus, commission, remuneration received by a partner from partnership firm is also taxable under PGBP head. Now you will be thinking, sir, interest should be taxable under IFOS, salary should come under salaries head, and this commission, remuneration should again go under salary head. No sir, why are we taxing it under PGBP head? Because mind you guys, partner is owner of a partnership firm. Part owner of a partnership firm. He is not an employee, and that is why the salary, interest, whatever received by a partner from the partnership firm in which he is a partner will be taxable under the PGBP head only. Further, we will be discussing about section 40B. At that time, you will be understanding what is this to the extent allowed under section 40B. Don't worry, at the end I will be teaching you 40B also. The third item is business of letting out of commercial properties. Now, generally, we have learnt under income from house property that if you let out any house property, in that case, rental income would be taxed under income from a house property head. But mind you, that was a residential house property. If you are into business of letting out, your business itself is letting out of commercial properties, then that Rental income, what the business will earn, will be treated as business income. Next one is non-compete fees. What is a non-compete fees? The best example is Ambani brothers. See, when Dhirubhai Ambani, the father of Anil Ambani and Mukesh Ambani, died or expired, there were lot of businesses, and those businesses were divided into two parts and given to Mukesh Ambani and Anil Ambani. When they got separated, they had an agreement, non-compete agreement, that, say for example, Reliance Communications, telecommunications was with Anil Ambani. So Anil Ambani told Mukesh Ambani that he should not get into telecom industry for another 10 years. But in order to do that, Mukesh Ambani will collect some non-compete fees from Anil Ambani. So that is called non-compete fees. That is also taxable under PGBP. Then some received for not sharing know-how, patent, copyright. During COVID, there was a company called as Bharat Biotech who invented the COVID vaccine. Now, COVID vaccine was exported throughout the world. Every country we exported from India. But China was an evil country at that point of time. No one was liking China because China is the place where from the COVID actually started. So, Modi may ask the Bharat Biotech company not to share the COVID vaccine formula with China. But Bharat Biotech will tell, sir, if we do not want to share, then you have to compensate us for that. And that is what is called some received for not sharing the know-how, patent, copyright. So Modi government paying money to Bharat Biotech for not sharing COVID vaccine formula with China. So Bharat Biotech, whatever money it will receive from Modi government, that will be taxable under PGBP head, because that is some received for not sharing a know-how. Know-how means the formula for COVID vaccine. Profit on sale of import entitlement license. See guys, if you want to import any goods from outside India, it is not so easy. You have to take a license from the Indian government that we will be exporting so many quantity of goods. Let's say for example, you took a license to import 1000 kgs, to import 1000 kgs of product. Or let's say for example, you took a license and you mentioned in that license that we will be importing for 100 crores of imports. But in this year, there is no business, there is no demand for your product. You were only, importing 50 crores. Rest 50 crores balance, you have the credit, the license. So someone asked you, we want to import, but we do not have license. Can we use your license? Please give me your license to us. We will use that 50 crores for import of our products. In that case, if you transfer the import entitlement license to someone, and if you earn some profit out of that license, that is also taxable under PGBP head. Some received from key man insurance policy. Generally, companies take insurance for the key man like CEO, CFO of a company, and if any insurance amount has received by the business, that is also taxable under the PGBP head. Duty drawback against exports, like duty refund, if you receive any duty refund, or subsidy on exports. If you export a lot, government will give you a lot of subsidies. All these subsidies are income for business, and that's why these duty drawbacks are treated as the business income and taxable in the hands of business. Profit on transfer of duty entitlement passbook. Duty entitlement passbook is also kind of, passbook which you have. If you export a lot, then you will get a lot of duty drawback or duty refunds. That is also, if you transfer that, and if you earn any kind of profit on duty entitlement passbook, that is also taxable under the PGBP head. The next section. So what we have discussed so far under section 28 are those items which are to be considered as income under the credit side in your profit and loss account as per the PGBP provisions. Now we will get into the debit side of profit and loss account. Later on, I will teach you at the end of section 41. 28 is done. Now we will get into the debit side of the profit and loss account, which we can claim as expenditures. The first section which we are going to discuss is section 30. Section 30 says that any rent, rates, taxes, repairs, insurance of a building, if you pay, that you can claim it as expenditure. Of course, if you are using any building for your business purpose, Then if you pay any rent for the building or any taxes for the building or any repairs, if you have done revenue repairs, you can claim. And if you have taken any insurance policy for the building, you can claim it as expenditure in your books of accounts. Correct or not? So that is dealt with in section 30. This is a expenditure section. But mind you, under section 30, we are discussing only about buildings, not other assets. So who is paying, and depending on who is paying, whether it will be allowed or not. If it is paid by owner, rent, if it is paid by owner, then it is not allowed. Means, say for example, I am owning a building. This classroom setup is owned by me only. The building is owned by me only. I cannot pay rent to my own self. No, it is my own building, so it will not be allowed. But all other expenses will be allowed, even though I am owner of the building. If I pay any taxes for the building, it is allowed as business expenditure because I'm using the building for my business, coaching business purpose. If I take any insurance, the insurance premium is allowed. Revenue repairs, if I do any, that is allowed. But mind you, capital repairs, we generally do not claim it as a business expenditure because capital expenditures or capital repairs, you have to capitalize in your books of accounts and you have to claim depreciation on that. So capital is that. If you are a tenant, you are not the owner of the building, you are a tenant, means you have taken on rent the building for your business purpose. In that case, of course, rent is a business expenditure in that case, so that is allowed. Taxes are allowed, insurance is allowed, insurance premium is allowed, and revenue repairs, if I any do for that building which I took on rent, even that is allowed as business expenditure because I am using it for my business purpose. But mind you, I am not the owner of the building. But if I do any capital repair, what will happen? Even then, if you have spent some capital expenditure on the building which you have taken on rent, still that also you will capitalize in your books of accounts and you will be treating that as, you will be treated as a deemed owner and you will be treating that as a deemed asset and you will claim depreciation on that. Capital repairs on building owned by, incurred by the owner. If you are owner and if you incur that expenditure, of course you will claim depreciation on that. You will capitalize it in books of accounts. But capital repairs on building incurred by tenant, in the hands of tenant, the capital expenditure will be treated as deemed asset. And mind you, even the tenant claim depreciation to that extent of capital expenditure which that that the tenant has incurred. So this was regarding section 30. The next section is section 31. This talks about repairs and insurance of plant and machinery and furniture. Section 30 was about building, but here we are talking about plant and machinery and furniture. Mind you, here we had taken rent also, but here rent is not available because it is not that you cannot claim rent as an expenditure. You can claim, but not under section 31. We will claim it under the general deductions section. So here only repairs and insurance of plant and machinery and furniture is covered. So if you are the owner of building which you are using for your business purpose, and of course you are paying rent, of course it is not allowed, but you are a tenant. I told you it will be allowed under general deduction section, under section 37. We will not allow under section 31. And insurance, revenue repairs, of course they are allowed, but capital repairs if you do in plant and machinery and furniture, not allowed. Of course you have to capitalize that and you can claim depreciation on that. Same provision as the earlier one. Now we will get into the next important, most important. Lot of times either a separate MCQ is asked on depreciation, or you will see that in the total income computation question, one complicated adjustment would be given on depreciation. You need to read this depreciation very, very carefully. Guys, whenever you want to claim depreciation under Income Tax Act under section 32, two conditions are very, very important. Both the conditions has to be met. Both the conditions has to be met. Condition number one, asset must be put to use, guys. Unless you put to use the asset, you cannot start claiming the depreciation. So you will start claiming the depreciation. You will calculate the depreciation from the day you started using the asset. Before put to use the asset, you cannot claim depreciation. First condition is that. The second condition is assessee must be owner of asset. If you are not owner of asset, you cannot claim depreciation under Income Tax Act. So these twin conditions has to be met. Now, when we say put to use, it can be two kinds of use, active use and passive use. Active use means actually you are using that asset. But passive use, fire extinguishers, you will just put it, you will mount it on the wall. That's all. When the fire will come, you will use it. But you have started using that asset, that is called as passive use. Both usage is good enough, but usage of the asset is very, very important. Next, in case of lease, depreciation can be claimed by lessor, because who is the owner of asset? Lessor is the owner of asset. And what I'm saying here, whoever is owner of the asset, they only can claim the depreciation. So in lease, lessor is the owner of asset, but giving on lease to lessee for usage of asset, but lessor only will always claim the depreciation. In case of hire purchase, what will happen, sir? In case of hire purchase, depreciation can be claimed by the buyer itself from the beginning. Are you getting it? Next. See, for depreciation purpose, the assets has been classified into different class categories. Class 1, building. Class 2, furniture. Class 3, plant and machinery. Class 4, intangible assets. Under this building also, we will see different kind of buildings, furniture, plant and machinery, intangibles. But keep in mind one thing. Building, furniture and intangible assets, apart from these three categories, whatever is there will fall under the plant and machinery category only. I repeat, whatever mentioned in building, furniture and intangible assets, apart from these three assets, whichever asset is there, that will fall always under plant and machinery category or class only, because this is a residuary class. Now, there are four assets on which depreciation is not allowed. Goodwill of business or profession, land, animals and tea bushes, you cannot claim depreciation. Now, we will look at what is the method of depreciation I need to use in case of Pgbp under income tax. Guys, in your accounting, you might have followed different methods of depreciation. You have to forget about it when you read income tax subject. Under income tax, there are only two methods of depreciation. One is called WDV method, the other is called straight line method or SLM method. You know what? It is mandatory under Income Tax Act to calculate the depreciation under WDV method only. It is mandatory. But there is only one exception. In case of power generation and distribution business, guys, they have the option, either they can claim depreciation under SLM method or WDV method. But all other businesses are mandatorily required to calculate the depreciation using WDV method only. They do not have option of SLM method. Now, we will look at the rates of depreciation. See, in your accountancy, you might have read something else regarding the rates of depreciation. Here, in income tax, the rates are prescribed. The rates are given separately. You have to follow these rates for claiming the depreciation. Building has been categorized into three categories. Residential building. You know what? Let's say, for example, Tata Consultancy Services, TCS, is providing building for residence of its employees. So there is a staff quarters which is owned by TCS company. So in the balance sheet of TCS company, on the asset side, staff quarters building is there. On that, TCS can claim depreciation at the rate of 5%. Other buildings, you can claim at the rate of 10%. Temporary building or structure. Some temporary structure is constructed. In that case, 40% depreciation can be claimed. Furniture, there is only one category, 10% you can claim on furniture. Intangible assets, patent, know-how, copyrights and all, you can claim 25%. In plant and machinery, the first one is motor vehicle. If you use motor vehicle for office use, in that case 15% you can claim depreciation, but due to government scheme, if you had purchased the plant and the motor vehicle between these dates, 23rd August 2019 till 31st of March 2020, in that case you are eligible for a higher depreciation. If you are into hiring business of motor vehicles, then you will get extra depreciation which is 30%. And if you had acquired during this duration, then the rate of depreciation which you claim is 45% you can claim. If you have a ship, you can claim 20%. For aircraft, 40%. Computer and computer software, very, very important. Lot of times in examination, they will ask you 40% you can claim. Pollution control equipments, 40%. Any kind of book you have, whether it is an annual publication, normal publication, library, business, anything, you're having a book as asset, 40% you can claim as depreciation. Renewable energy devices, including e-vehicle, if you have, that 40% you can claim as depreciation. Windmill and equipment, if you purchased before 1/4/2014, 15% you can claim, and on or after 1/4/2014 you can claim 40% depreciation. Oil wells, you can claim 15% depreciation, and any other plant and machinery, guys, whichever is not mentioned specifically above, you can claim 15% as depreciation. Mobile phones and EPABX, you can claim 15%, and printer, scanner, UPS, these are treated as computer only, you can claim 40%. Now you'll get a doubt, sir. Do we need to remember these depreciation rates for our examination purpose? Yes, you need to remember. At least you need to remember plant and machinery 15%, computer 40%, furniture 10%, building 20%, 10%. Like this, you need to remember, very, very important. So system of depreciation, I already told you. For a power generation business, SLM method or WDV method, whichever is beneficial for them, they can actually follow. But all other businesses are mandatorily required to follow WDV method. You know what? In accounting, what do? You calculate the depreciation for each asset separately, but you cannot follow that method in income tax. You have to follow something called as block of asset method. Means you will block the assets which are falling under the same class and same rate, and you will group the assets and you will create something called as block of asset. On the total block, you will calculate the depreciation. So same class of asset. What is a class of asset? Building is a class, furniture is a class, plant and machinery is a class, intangible asset is a class. Same class and same rate of depreciation asset. In building, there may be 5% depreciation building, there may be 10% depreciation building. But you cannot create a block using 5% building and 10% building. No. You will create a block using same 5% building 1, 5% building 2. Like that, you can create a block. Once you create a block, how will you calculate the depreciation is the question. First, always take the opening WDV of the block. To that, you will add three things. First, you will add into the block the asset which you have put to use more than 180 days. That value you will add here. Then you will add the value of asset which you have used for less than 180 days. And also you will add the asset not put to use. You acquired but not put to use, also you will add. But you will get a doubt, sir. For depreciation purpose, why are we adding the asset not put to use? Because it is not eligible for depreciation. Don't worry. That you will gradually know in some time. But we have to add it because ultimately it forms part of the block. You're not claiming depreciation on that, but it should form part of the block. And you will remove the selling price of asset, means any assets which you have sold during the year, that amount you have to reduce. The sale price you have to reduce of any of these assets. If you sold during the year, you have to reduce that. Then you will get WDV for the purpose of depreciation. This WDV for the purpose of depreciation, whatever is that you will take here separately, WDV for depreciation purpose. And you will follow these steps to calculate the depreciation. Step 1. You have to, from the WDV for the purpose of depreciation, whatever it has come here, from that you have to reduce in step 1. First, you reduce those assets which you acquired and not put to use. So automatically you are not claiming depreciation on that. No depreciation, just ignore this. Then second, you will take asset acquired and put to use less than 180 days on or after 4th October. Guys, always remember, Until 3rd October, if you use the asset, then you have used the asset for full year. If you started using the asset on 4th October and later on anytime during the year, then you have to claim half rate of depreciation because you are using the asset for less than 180 days. So asset acquired and put to use less than 180 days, whatever is there, on that you claim half rate of depreciation. And on the balance assets, you can claim full rate of depreciation because the balance assets are those assets on which you have used for more than 180 days. Now, rules for depreciation. If asset is acquired during the previous year and put to use for less than 180 days in that previous year, in that case, you will claim half rate of depreciation. Let's say, for example, you acquired an asset during the year and you put to use the asset in this year only in which you acquired for less than 180 days, you will claim half rate of depreciation only. But mind you guys, very, very important point. If you acquired an asset in this current previous year, but you did not put to use the asset in this previous year, you put to use the asset in the next previous year. And in next previous year, if you use the asset for less than 180 days, still you will claim full rate of depreciation only. Because the 180 days less high, more than 180 days, less than 180 days condition is applicable only if the asset is put to use in the year in which you acquired it. If acquisition year is different from put to use year, you will not check less than 180, more than 180 days. Next, always first calculate depreciation on asset put to use less than 180 days and then balance WDV for depreciation. This we already have seen in the table. So what will happen once you will take this WDV for depreciation purpose, you will reduce the depreciation from here and the balance will be called as closing WDV of the block. So from this you calculate depreciation and reduce here and the balance will be called as closing WDV of the block. This closing WDV will be taken to the next year and that will be called as opening WDV for the next year. Important points, very, very important. If the asset is put to use for less than 180 days, of course, you will claim only half rate of depreciation. But mind you, this is applicable only in year of purchase. If you use it next year, not applicable like this. Put to use up to 3rd October means full rate. Means from 1st April of the previous year till 3rd October, if you start putting the use the asset, then you can claim full rate of depreciation. But if you put to use the asset on or after 4th October, always you can claim half rate of depreciation. Any asset sold during the year does not qualify for depreciation. That anyway gets reduced for the WDV purpose for depreciation. Additional depreciation. Whatever we have discussed so far above was a normal depreciation. This was normal depreciation. But there are some special cases in which you will be getting additional depreciation in addition to the normal depreciation. That is dealt with in section 32(1)(2)(a). But there are some conditions attached to it. Only if you satisfy the conditions, you can actually claim the additional depreciation. The first condition is the new plant and machinery should be there and that new plant and machinery only eligible for depreciation. If you buy second hand plant and machinery, you cannot claim additional depreciation on that. And mind you, the additional depreciation is eligible only on plant and machinery and not on other assets. And the plant and machinery should be brand new. You cannot buy second hand plant and machineries is not eligible for additional depreciation. You may claim a normal depreciation. And the assessee who wants to claim additional depreciation should be engaged in manufacturing business or power generation, distribution, transmission business. Only if you are into these two kinds of businesses, you are eligible for additional depreciation. And mind you, one more very important thing. This additional depreciation is not eligible under default tax regime. This is only available under optional tax regime only. And one more thing. If you want to claim additional depreciation, you should must follow WDV method of depreciation only. If you follow SLM method of depreciation, you cannot claim additional depreciation. Sir, what is the rate of additional depreciation? You will be eligible to claim additional depreciation at the rate of 20%. But if you put to use the asset, the new asset which you purchase, new plant and machinery, if you used for less than 180 days, you can only claim half rate of depreciation. And mind you, this additional depreciation, let's say for example, you purchased the asset in this year, you used it for less than 180 days. So additional depreciation you will claim half this year. Means 20% half is 10% in the first year and the rest 10% you will claim in the next year. Got it? Next. Plant and machinery used in office or residence is not eligible for additional depreciation. Means the plant and machinery whichever you purchased, you should use that plant and machinery for manufacturing purpose only. If the plant and machinery which you purchased is used for other than manufacturing purpose, you are not eligible for additional depreciation. If you use that in office or residence purpose, then it is not eligible for depreciation. But there is an asset called as forklift truck. You know, in big factories, you will see one mini truck will be there, which will, lift all the raw materials and take it to the manufacturing machine. That forklift truck is eligible for additional depreciation because that truck you are using for manufacturing purpose only. So additional depreciation you can claim. Mind you, printing business is specifically mentioned as the manufacturing business only, and that is why in printing business, even if you buy any machinery, that is also eligible for additional depreciation, guys. Rule: additional depreciation is not allowed every year. Assessee can claim only in the year for the first time you put to use. So not additional depreciation is not allowed for every year for the lifetime of the asset. No, only first time when you put to use the asset, in that year you can claim the additional depreciation. So that was from the standpoint of normal depreciation, additional depreciation, very important points. Now we will get into the actual cost of asset, what we need to consider. This is given under section 43.1. See guys, cost of asset will be capitalized in the books of accounts. But what are those items? What are those factors which we need to consider as cost of asset? Cost of asset may be different things. See, let's say for example, you purchased one plant and machinery. That price of the plant and machinery is actually cost of asset, no doubt. But apart from the price of machinery which you spent, you might have spent some additional cost like installation cost, trial expenditure cost, some taxes you might have paid, some interest on loan you would have paid, transport expenses from the from the seller till your factory, and installation expenses. These are some extra expenses which you might have spent for purchasing the asset. Are these expenses can also be capitalized and can we claim depreciation on that is the question. And that is clarified in this section 43.1, which says that actual cost of asset will include actual purchase price of the asset. To that we will add transportation expenses for getting the asset from the seller's godown to your factory, installation expenses which you spent to install the machinery, trial run or testing expenses if you spent something, taxes and duties. But mind you, taxes and duties you can only consider if the credit of that taxes you have not received. If you are receiving the credit of that GST credit, if you are receiving, in that case you cannot claim it. So if tax credit is allowed, then not claimed. Interest on loan, always keep in mind one thing guys, interest on loan. If you have taken loan for purchasing an asset, in that case you can capitalize the interest which you paid from the day you purchased the asset till the date you put to use the asset. Let's say for example, you purchased the asset on, let's say for example, 15th of July 2025, you purchased the asset. But You put to use the asset on 15 December 2025. So July to August, September, October, November, December, 5 months you did not put to use the asset. Mind you, if you had taken any loan for purchase of this asset, of course you will be paying interest now to the bank from which you took loan. Now 5 months interest which you paid for this asset, you have to actually add it to the cost of asset. That is called capitalizing the interest. And whatever interest you will pay after 15th of December has to go and hit your profit and loss account debit side, because once you start putting use the asset, whatever interest you will be paying for the asset purpose, asset loan purpose, that you can claim it as revenue expenditure only. So up to the date on which the asset is put to use, you will capitalize and you will add it to the cost of asset, mind you guys. Then from the cost of asset, there are some things which you need to actually reduce. Sale of trial run product. So when you did the trial run, you got some products out of the machinery, that whatever products you sold outside, that you have to reduce. And if you got any government grant for the asset, that also you can reduce, and the net will be called as total cost of asset. On this asset, you will start claiming the depreciation. This asset will go and capitalize in your books of accounts. And very important point, whenever you purchase an asset, you have to make the payment for that asset through the prescribed modes of payment only. You cannot make payment of more than 10,000 in cash for purchase of asset. Say for example, you purchased an asset, plant and machinery. Let's say for example, you purchased an asset, plant and machinery, for which you spent 4 lakh rupees. This 4 lakhs you made payment through NEFT, means banking channels, then that will go and you can easily capitalize that in your books of accounts. But let's say for example, for installing this machinery, 15,000 you made payment in cash. See, installation expenses generally you need to add to the cost of asset, but since you made the payment of more than 10,000 in cash, you cannot add that value to the cost of asset, because more than 10,000 if you make any payment in cash for buying an asset, then to the extent to which you made cash payment will not be eligible for depreciation. You cannot capitalize that in your books of accounts. Let's say for example, you further spent transportation expenses of 9,000 in cash. This 9,000 you spent in cash is less than 10,000, that you can add to cost of asset, because this is a different expenditure. Now, important section 43(1). If any payment is made in relation to acquisition of asset more than 10,000, very important, more than 10,000 if you have made by any mode other than account pay check, account pay demand draft or electronic clearing system to a single person in a single day, then such expenditure shall not be included in the actual cost. Similar dialogue you will find in section 40A(3) also, correct? So to a single person in a single day, if you have made any payment more than 10,000 in other than prescribed modes. What are the prescribed modes? Electronic clearing system, account pay check, account pay demand draft. These are the prescribed modes. If you do not make payment in the prescribed modes, then forget about depreciation on that. Forget about you will capitalize the asset in your books of accounts. You cannot capitalize. There may be some scenarios where personal asset is converted into business asset. Lot of times what happens, assessee will convert his personal asset into business asset. Let's say for example, there is your own building which you are using for your residence purpose. Suddenly you thought, why not I use this asset for my business purpose? In that case, what will happen? Let's say for example, there is a building which you purchased in the previous year 22-23. And you converted this building into business asset in previous year 25-26. In that case, there is a question mark, and the question mark is, what should be the cost of asset in the business books which I have to consider? If you have to consider the cost of asset in the business books, you will first take the actual cost of building, From that, you have to reduce the notional depreciation. Notional depreciation will start from this day till the date you convert it into the business asset. And the net amount will be treated as actual cost of asset in business books. Say for example, the cost of acquisition was 15 lakhs when you purchased this building on 19th of February 2023. So you purchased in 22-23 February 22-23 financial year. Right from previous year 22-23 till 22-25-26, the asset was personal asset. Now you want to get into business. In that case, what will happen? First, you will take the actual cost of 15 lakhs and you start claiming the depreciation. Sir, why you took 5% here? Because you have purchased the asset in February. February means less than 180 days. So 10% has become half 5%. In 23-24 full depreciation, 25-24 to 24-25 full depreciation, and if you reduce this depreciation, this is the amount of actual cost of building which you will start adding to the block of asset, and you can claim depreciation on this value in your business books. You will have to always follow WDV method of depreciation. The above provision only applies in case of building, mind you. Here I am telling you personal asset converted into business asset. When I say this asset means only building. If you convert your personal car into business, personal asset of car into business asset, you will not use this kind of provision. This provision is applicable only in case of personal asset, business asset being a building. Sir, what will happen if I convert my personal car? Car is also an asset only, sir. If I convert my personal car into business car asset, what will happen? In that case, you will take the actual cost only. See, if a car is converted, personal car is converted into business asset, then see, cost of acquisition remains the same. You will not reduce notional depreciation. So, it is not applicable in case of any asset other than a building. If any other personal asset is converted into business asset, always take the actual cost of acquisition only without claiming the notional depreciation, mind you. Next, other important points. Any asset acquired by way of gift or inheritance or will, then actual cost will be cost to previous owner minus depreciation allowed to previous owner. Guys, let's say for example, someone gifted you asset, or you got the asset through will or inheritance from your ancestors. Then what should be the cost of asset in your books of accounts in business? In that case, mind you, you will take the actual cost to the previous owner. Means, let's say for example, you got the asset from your father as a gift. So what was the cost of acquisition in the hands of father minus depreciation which has to be allowed to the previous owner for the period for which your father was using the asset. Next, if any stock in trade is converted into capital asset, and if such capital asset is used in business, then actual cost shall be FMV as on the date of conversion. Let's say for example, you have some stock in trade. You want to convert that stock in trade into your capital asset in your business purpose. In that case, on the day on which you will convert the stock in trade into capital asset, the fair market value, whatever is there, that will be treated as the actual cost in your in your block of asset, because you are converting it to stock in trade into a capital asset. If any asset is acquired, let's say for example at a higher value, if you acquire any asset at a higher value just to claim more depreciation, in that case, mind you, the assessing officer will decide what should be the actual cost of asset. So if any asset is acquired at a higher value just to claim higher depreciation, let's say for example, an asset fair market value is just 10 lakh rupees, but you are acquiring the asset for 1 crore. Only this is book entry. You are not actually paying 1 crore to the seller. Seller is also known party for you. 10 lakhs worth of asset you are purchasing on papers for 1 crore. Now, if you purchase for 1 crore, on a higher amount, you will start claiming the depreciation. In that case, the cost of asset will be decided by the assessing officer with the prior approval of a joint commissioner, guys. If any asset, let's say for example, you first transfer the asset and then you reacquire the asset at a higher value just to claim higher depreciation. In that case, the actual cost will become the WDV when you actually transferred, or reacquisition cost means at the price at which you actually reacquired. Whichever is lower, that price only will be considered as your cost of asset for your depreciation purpose. These are some special cases. Next one. If any asset is acquired from any person and leased back to the same person, then actual cost shall be the WDV of seller. So in these special cases, you have to take the cost of acquisition which is given here. Now, guys, one dialogue I'll tell you which has to be very important dialogue. And the dialogue is, a block of asset can be nil but cannot never be negative. I repeat, a block of asset may have multiple assets in it, because what is a block of asset? Same class and same rate of assets. You will create a block. Maybe you may be having 4 machineries, 5 machineries of the same class, same rate. That is called a block. A block can be nil, 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 but it can never be negative. With this dialogue, I will take you through one scenarios, different scenarios I will show you. Let's say for example, there is an opening WDV of a block of 10 lakhs. And in that block, there are 10 assets opening. Means at the start of the year, you had 10 assets in the block, for example. And during the year, you purchased 4 assets. So, and the 4 assets you purchased for 4 lakhs. If you remember that depreciation table, opening WDV, add purchases, then you reduce the sale value, you will arrive at the WDV for the purpose of depreciation. From that you reduce the depreciation and then you arrive at the closing WDV of the block. So opening WDV plus purchases. Opening WDV was 10 lakhs and 4 lakhs you purchased new assets during the year. 10 assets were in opening WDV at the start of the year. 4 assets you purchased during the year. Now, totally 14 assets are there in your hands. 14 assets value is 14 lakhs. Say for example, if you sell 8 assets out of 14 assets, are you selling all the assets in the block? No. You are only selling partial block. Means out of 14 assets, you sold 8 assets. But the problem is, 8 assets you sold for a value more than the total value of the block. Total assets, all the 14 assets put together, the value is 14 lakhs. But you sold only 8 assets at a value higher than the value of the block. Then block cannot exist. Because you just think logically, 14 lakhs worth of assets you sold for 18 lakhs already. In that case, what you will get? If you reduce 14 minus 18 lakhs, you will get negative figure of 4 lakhs. But just now I told you, block can never be negative, guys. Block can never be negative. So, the WDV of the block will become nil and block will cease to exist. But you will be getting a doubt. Sir, out of 14 assets, we sold only 8 assets. No, sir. 6 assets are still remaining. How can you say block has ceased to exist? The block is ceased to exist because of this effect. Assets are there in the block, but there is no value in the block. Because block can never be negative, you have to do it 0 only here. Nil it will become. And mind you, 14 lakh worth of assets, if you sold it for 18 lakhs, haven't you sold it for a higher value? If you sell any asset for higher value, capital gain will come or not. And that is why you see short-term capital gain, 18 lakhs minus 14 lakhs, 4 lakhs of short-term capital gain will come. Sir, why we are not calling it as a long-term capital gain, sir? Because any depreciable asset you sell, all the time it will be short-term capital gain only. On depreciable assets, you can never get long-term capital gain. Always you will get a short-term capital gain only, irrespective of period of holding. You might be holding the asset for more than 2 years, 3 years, whatever. But all the time it will come short-term capital gain only, mind you. Next scenario I'll take. Opening WDV of the block was at 10 lakhs and 10 assets were there at the start of the year. You purchased 4 lakhs worth of assets, 4 assets you purchased. Totally 14 assets are there in the block, 14 lakhs worth of assets are there. During the year, you sold only 8 assets out of 14 assets. Still, 6 assets are there in your hand. But mind you, 14 lakh worth of assets are there, but you sold it only for 8 lakhs only. The sale value is 8 lakhs. Now, is there any issue? No. 14 lakhs minus 8 lakhs, naturally you do on whatever 6 lakhs remaining figure is there. That is your WDV for depreciation purpose and calculate depreciation on that. There is no capital gain or loss. You cannot say, sir, 14 lakhs worth of asset, I sold for 8 lakhs only, 6 lakhs should be short-term capital loss. No, that is not a short-term capital loss. Because I'll tell you why. Because 14 assets you did not sell. You sold only 8 assets. Still 6 assets are remaining in your block. If you had sold all the 14 assets for only just 8 lakhs, then you can say 6 lakhs is a short-term capital loss. So the block is continuing, block exists here, and that is why there is no short-term capital loss coming here. And the block is existing, on this you will claim depreciation. No capital gain or loss. Third scenario I'll take. Opening WDV you had 10 lakhs, 10 assets you had opening at the start of the year. 4 assets you purchased for 4 lakh rupees. Totally 14 assets you have. Out of 14 assets, you sold all 14 assets. You sold all 14 assets. Is there any asset in the block now? No. 14 lakh worth of assets you sold for 20 lakhs, mind you. You have sold for a higher value. Then you will get short-term capital gain or not. Of course, you will get. So, short-term capital gain will be 20 lakhs minus 14 lakhs, which is 6 lakhs. And the block will cease to exist. Why? The block will cease to exist because all the 14 assets are sold in the block. There is no asset in the block. Next one. Opening WDV 10 lakhs, 10 assets were there. 4 assets you purchased for 4 lakhs. Total 14 assets you have worth of 14 lakhs. Now mind you, all the 14 assets you have sold during the year. But you sold only for 8 lakhs. 14 lakhs worth of asset, if you sell just for 8 lakhs, you have a loss or not there? Because you have sold all the assets, now you will get short-term capital loss of 6 lakhs and the block will cease to exist. Are you getting it? Now, based on these examples, now we will understand this table. Scenario, few assets are sold, all assets are sold. Whatever 4 scenarios I taught you, this has been given here in a summarized table manner. Scenario 1, Scenario 2, Scenario 3, Scenario 4. In Scenario 1 and 2, we are only selling few assets. In Scenario 3 and 4, we are selling all the assets in the block. Now, total number of blocks, total number of assets in the opening WDV were 10 assets were there. Let's take the Scenario 1. So, 10 assets opening were there. 4 you purchased. Total assets before sale. Total assets before sale was 14. How many assets you sold during the year? Only 8. But mind you, is the sale value more than opening WDV plus purchases? If it is yes, then of course your block will become nil. Because block can be nil but can never be negative. Short-term capital gain also will arise in this case. You see here, 1 star mark is given, means this point. Second scenario, 10 assets in the opening, 4 you purchased, totally 14 assets are there, out of which 8 you sold. But is the sale value more than opening WDV plus purchases? No. In that case, what will happen? Depreciation shall be computed because this is the balance, means the blocks exists and you can claim depreciation on the balance. 10 assets opening were there, 4 you purchased, total 14 assets are there, out of which all 14 you sold. And is the sale value more than opening plus WDV plus purchase? Yes. So you sold for a value more than opening WDV plus purchases, then you will get a short-term capital gain, and that's why here short-term capital gain will come. Last scenario, 10 opening assets, 4 assets you purchased, total 14 assets are there. Out of 14, all 14 you sold. But is the sale value more than opening WDV plus purchases? No, means you sold it for a loss, and that's why short-term capital loss will come. I hope that is clear. As per section 50, capital gain or loss on sale of depreciable assets shall always be short-term only, irrespective of holding period of the asset. Next. If asset used partly for business purpose and partly for personal purpose, what will happen? Of course, guys, under PGBP, one dialogue you remember always. Only business related expenses are allowed. Personal expenses are not allowed. So if asset is used both for business purpose and personal purpose, only to the extent you used it for business purpose is allowed. To the extent you used for personal purpose is not allowed. Got it? So we'll see this with the help of one example. Let's say, for example, there is one car which you are using for personal purpose also, business purpose also. Business purpose you are using for 60% and 40% you are using for personal purpose. Now, on this car, since it is a business asset, you will claim depreciation on that. How will you claim the depreciation? Let's say, for example, opening WDV of the asset was 4 lakhs. On this 4 lakhs, you will claim depreciation at the rate of 15%, which is 60,000, but you cannot claim total 60,000 as depreciation. Out of the 60,000, only 60% you can claim is as business expenditure, because only 60% of the asset is used for business purpose. So 60,000 into 60%, 36,000 allowed as depreciation. 40% which you use for personal use will not be allowed as depreciation. So 24,000 is disallowed, not allowable. Next. Sale of asset by power generation units following SLM method of depreciation. Guys, in case of power generation units, who is following the SLM method of depreciation? Whenever this power generation unit will sell an asset, in that case, we will generally get two kinds of scenarios: balancing charge and terminal depreciation. Let's say, for example, if you are selling an asset and the sale price is less than WDV, what you will be thinking? If the sale price is less than WDV, it should become a short-term capital loss, you will be thinking, but it is not correct, because this is a special case in case of power generation units who is following SLM method. If the asset is sold for less than the WDV value, in that case, terminal depreciation will come. Means terminal depreciation, you have to claim it as expenditure in your profit and loss account. Sale price, if it is 80,000, WDV was 1 lakh, then the 20,000 will be called as terminal depreciation, and you can claim this as your profit and loss account debit side as an expenditure. This is called terminal depreciation. But if the sale price is more than WDV, what will happen? See, there may be two kinds of scenarios. If the sale price is more than WDV, you have to check whether the sale price is exceeding the cost of acquisition or not. If the sale price is exceeding cost of acquisition, you will get capital gain also, short-term capital gain. But if the sale price is more than WDV, but the sale price is not more than cost of acquisition, then you will get balancing charge, which you have to take it to the credit side of your profit and loss account. So if the sale price is more than cost of acquisition, two things will come. Balancing charge also will come, capital gain also will come, short-term capital gain. We'll take one example. Let's say, for example, WDV of the asset is 80,000. Cost of acquisition is 1,50,000 and the selling price is 2 lakhs. Now you see here, you sold for 2 lakhs, which is more than the cost of acquisition. Then you should get a capital gain. No, cost of asset is less than the sale price, means there is a capital gain. But 2 lakhs minus 1,50,000, of course you will get 50,000 as short-term capital gain, but you have to see cost of acquisition minus WDV. To this extent, whatever 70,000 profit you got, that will be called as balancing charge and it will go to PGBP income. So whenever a sale price is more than the cost of acquisition, you will get two kinds of income. One is PGBP income, the other is short-term capital gain. So to the extent of cost of acquisition, the difference between the cost of acquisition and WDB will be called as balancing charge, which is PGBP income. And the amount for which you sold, the sale price which is exceeding the cost of acquisition, that will be treated as your short-term capital gain. There may be scenario where your sale price is more than WDB, but it is less than cost of acquisition. Possible? We'll take one example. Let's say, for example, the cost of acquisition of your asset was 1 lakh. Sale price was 80,000 and the WDB was 50,000. Did you sell more than WDB? Yes, of course. But did you sell more than cost of acquisition? No. So in this scenario, you will not get a short-term capital gain, but you will get balancing charge, which you will take it to PGBP income. So what is the balancing charge? Simple. Your sale price is 80,000. Your WDB is 50,000. 30,000 will be treated as balancing charge and PGBP income will arise here. Next. Section 35, scientific research. Guys, in order to promote scientific research in the country, especially for pharmaceutical industries in India, government is giving one opportunity to all those people who want to come into the scientific research industry. If you start any scientific research business and if you do some research, whatever expenditure you incur, fully we will give as deduction, is what the government is saying. So there may be two kinds of scenarios. Either you do in your own business the scientific research, or you promote someone, or you donate money to some organizations who are doing the scientific research. There are two possibilities. If you do in-house research means in your own organization, in your own business, you are only doing the research. In that case, you can claim deduction of both revenue expenditure and capital expenditure. Revenue expenditure and capital expenditure, and mind you, before even you start your business, you might have incurred some expenditures. That is called a pre-commencement expenditure, or before commencement of your business, you might have spent some expenditure. In that case, before starting your business, if you have incurred any kind of revenue expenditures, only two kinds of revenue expenditure are allowed. One is a salary and the other is raw material. But mind you, here perquisites in salary will not be allowed. So before starting your business, up to maximum 3 years, whatever salary expenditure and raw material expenditure you incurred for in-house research, scientific research, that you can claim 100% as expenditure, it is allowed. But mind you, maximum 3 years it is allowed. But once you commence your business, whatever scientific research expenditure, revenue expenditure you incurred, full 100% it is allowed. There is no restriction at all. And when it comes to capital expenditure, whether it is before or after commencement, 100% of capital expenditure is allowed. But mind you, except land. Land is not eligible for claiming deduction under section 35 as expenditure. So very simple, guys. If you are doing in your own business scientific research, before starting your business, maximum 3 years before starting your business, revenue expenditure, only two kinds of revenue expenditure you can claim. Salary, but excluding perquisites, and raw material also you can claim. 100% of it is allowed. And before starting your business, before commencing your business, if you had done some capital expenditures, in that case, all kinds of capital expenditure are allowed. 100% it is allowed, except land. Once you commence your business, any kind of revenue expenditure is allowed. Any nature of revenue expenditure, 100% it is allowed. And capital expenditure also, any kind of capital expenditure, 100% it is allowed, except land. This is in-house research, means in your own business, in your own company, if you do research. But let's say, for example, you are not having any research kind of a business, but you want to help someone who is doing research in the country. You want to donate some money for these kind of organizations, and if you donate that amount, whatever donation you make to these research institutes, 100% of the amount you can claim as expenditure whenever whatever amount you donate to this organization. Donation or contribution to notified or approved organizations. Only notified organization or approved organizations, if you give contribution, then only allowed. If you give contribution or donation to unapproved organization, then you cannot claim deduction. 100% allowed, guys. Let's say, for example, you gave 100 crores to some organization for scientific research, fully allowed. You gave 50 crores to some organization, fully allowed. Who are these organizations, sir, to which we can give, contribute or donate money? Scientific research or social research or statistical research organization, any university, Indian Institute of Technology, college, national lab, or any Indian company which is into research business. Mind you, this donation expenditure you can claim only if you are paying tax under optional tax regime. Guys, mind you, in-house research, whenever you do in-house research in your own business, irrespective of what kind of regime you are paying tax, whether you are paying tax under default tax regime or you are paying tax under optional tax regime, under both the tax regime you are eligible for 100% expenditures, which is mentioned here. But whenever you contribute or donate money to other organizations, you will get the deduction only if you pay tax under optional tax regime. If you pay tax under default tax regime, forget about the donation or contribution expenditure, you will not get it. Important note for section 35. Depreciation is not allowed. Of course, guys, if you already claimed capital expenditure 100%, let's say for example, you have purchased one building for scientific research, already you claimed 100% as deduction under section 35, then there is no scope for depreciation further. Next, if land and building, if you purchase both put together, then what will happen? Of course, bifurcate the land value and building value separately. Land is not eligible, only building value is eligible. And guys, one more thing, in future, so you donated some money to some organization, any of this organization you donated some money, and later on this organization's approval is withdrawn, that will not have any kind of impact on your calculation of tax liability. And mind you, donation is not allowed under default tax regime, only if you are paying tax under optional tax regime, then only whatever contributions you will make to the approved organizations you can claim as deduction under section 35. The next section is 35D, preliminary expenses. Just give me a second. 1 second, guys. Yeah. 35D, preliminary expenses. Guys, a lot of times there may be two kinds of scenarios. Either before starting your business, you are incurring some expenditures, or you already have an existing business, you want to expand your business, you want to start a new undertaking, new unit, new branch. In that case also you have to incur a lot of expenses because you have to establish that business. Or you want to start a new business altogether. In that case, of course, in order to start a new business, there will be a lot of legal expenses. No, you have to register your business, you have to draft MOA, AOA, like this. There are a lot of expenses incurred. So before starting any business, if you incur any expenditure, that expenditure you can claim as your business expenditure as soon as you have started your business. That is called preliminary expenses. Before starting your, preliminary means before starting the business. Cost of setting up a new business or expanding old business is eligible. Applies to Indian taxpayers only, not for foreign entities who establish their business in India. How much of expenditure is allowed, sir? 1/5 of eligible expenses only allowed. Now you'll ask, sir, what is eligible expense? Eligible expense is given here. Eligible expense is nothing but if you are a resident non-corporate. Non-corporate means what? You are not a company. You may be starting one sole proprietor. You may be starting one partnership firm. You may be starting one LLP. In that case, In that case, 5% of cost of project is eligible, maximum eligible amount. And if you are a company, in that case, you have to compare two things, higher of 5% of the cost of project and 5% of capital employed, whichever is higher will be maximum eligible amount. And the deduction will be, of course, 1/5 of the maximum eligible amount. Now, what is cost of project and capital employed, sir? You will get it out. See, cost of project means actual cost of all the fixed assets which you have as on the last day of the previous year in which you started the business. And capital employed means issued share capital plus debentures plus long-term borrowings, all these put together as on the last day of the previous year in which you commenced your business. But mind you, here you should not include reserves and surplus and securities premium. So this you will consider for cost of project and capital employed, and only 1/5 of the expenditure is allowed. Generally, what kind of expenses it can be, sir? Feasibility report, project report, MOA drafting, AOA drafting, legal charges, registration fee. These kind of expenses are allowed here. And 1/5 you will start claiming the expenditure. Let's say, for example, last year you incurred all this expenditure, preliminary expenses. So, of course, you will start claiming the expenditure from the year in which you started your business. For 5 years, you will claim. This year 1/5, next year 1/5, next year 1/5, next year 1/5, next year 1/5. Like this, 5 years you will claim 1/5, 1/5. Then in 5 years, you will be eligible to claim all the expenditures. Amortization of expenditure incurred under voluntary retirement scheme. Guys, what is voluntary retirement scheme? A lot of times you give an opportunity to the employee to retire voluntarily. And if they retire, you have to compensate them. That is called voluntary retirement scheme amount, which you pay as being an employer. If you pay any kind of voluntary retirement expenditure, that is also allowed 1/5 only. 1/5, 1/5, it will be allowed for 5 years. So summary of 35D and DDA is very simple. In 35D, preliminary expenses of business are covered for resident assessees only. Limit is 5% of COP or capital employed, whatever, and 1/5 is allowed. But in 35 DDA, under voluntary retirement, any assessee can take. There is no limit, but 1/5 only allowed. 1/5, 1/5, like this, 5 years they will allow the expenditure. The next section which we are going to discuss is section 35AD, specified business. This is optional expenditure which you can claim. And one more thing, 35AD also you can claim only under optional tax regime. Under default tax regime, you cannot claim this. And now, what is 35AD? Guys, in order to boost infrastructure of the country, in order to boost some particular businesses in the country, the government is giving one option to the business people. If they invest in any of these listed businesses, if anyone starts any of these businesses and incurs any kind of capital expenditure, full capital expenditure will be allowed in the first year of business itself. Full 100% you can claim. Generally, if you incur any capital expenditure, you have to first create a block, then depreciation every year you will allow 10%, 5%, year on year you have to allow. So it will take some 5 to 10 years for you to claim the whole capital expenditure. But this option is amazing. If you start any of these businesses in the year in which you start the business itself, 100% of the capital expenditure you can claim in the first year itself. Beautiful this is. Or whenever, even after starting your business, whenever you will buy any kind of capital asset, in the year in which you buy the capital asset itself, you can claim the 100% of the cost of asset as expenditure. Beautiful opportunity this is. But mind you, there are 3 kinds of capital assets which are not eligible for deduction under section 35AD. One is goodwill, the other is financial instruments, and the third one is land. If you invest in these kind of capital expenditures or capital assets, you are not eligible for deduction under section 35AD. Apart from this, whatever you invest, you buy building, you buy plant and machinery, you buy a car, you buy anything, any kind of a capital asset, 100% of the capital expenditure is allowed in your books of accounts. Sir, what are these eligible businesses, sir? First business is cold chain facility. For storing agriculture produce, fish, meat, etc. Warehouse, big warehouses will be there, no, for agriculture produce or sugar. Guys, you have to ratify this, you have to mug these list of businesses, because in examination they will not specifically tell this is 35AD business like that. They will simply tell assessee started this kind of a business. You have to connect that, okay, this is 35AD business like that. You have to understand, you have to remember, there is no option. Pipeline for gas, petrol, oil, iron ore, or hotel of 2 star or above, 2 star, 3 star, 5 star hotel like that if you start, or you have a hospital where minimum 100 beds are there. Housing project for affordable and slum redevelopment, or fertilizer production business, or inland container depot business, beekeeping and production of honey and wax business, semiconductor wafer manufacturing business, or develop and maintain infrastructure facilities. If you start any of these businesses and if you incur only capital expenditure, not revenue, only capital expenditure you incur in the year in which you will incur the capital expenditure, 100% will be allowed. But except these three, but there are some conditions attached to it. Conditions for claiming 35AD. It should be a new business setup and a new plant and machinery. It should be a new plant and machinery, but guys, old plant and machinery can be maximum 20%. Let's say, for example, you invested 1 crore in plant and machinery. Out of 1 crore plant and machinery, you can have maximum 20 lakhs of old plant and machinery. No problem. No problem. You will get total deduction. And one more thing, imported old plant and machinery will be treated as new only. Means in India, if you purchase any old plant and machinery, it is old. But if you import any old plant and machinery, it will not be treated as old. It will be treated as new only. No deduction under default tax regime. Just now I told you only under optional tax regime you can claim 35AD. Guys, remember under Pgbp, remember one thing. 32(1)(2)(a) additional depreciation only available under optional tax regime. Section 35 donation to other institutions, research institutions only available under default only available under optional tax regime. And similarly 35AD is also such a section where you will be eligible to claim the deduction only under optional tax regime. Under default tax regime, these three are not allowed. Under default tax regime, only these three are not allowed, rest everything is allowed. What are these three things? Additional depreciation, 35 donation to scientific research organizations, and number 3 35AD specified business. These three are not allowed under default tax regime, mind you. No depreciation allowed, of course. No, already 100% of the cost of asset, it is already allowed as deduction under 35AD. Where is the scope of depreciation? Pre-commencement capital expenses also fully allowed. Means before even starting your business, you might have spent some capital expenditure, even that you can claim it as 100% deduction. Mind you guys, here lock-in period is there for 8 years. Once you purchase an asset and once you claimed 35AD deduction, minimum 8 years you should not sell the asset. Minimum 8 years. Whatever asset you purchased here and you claimed deduction under 35AD, you cannot sell the asset for 8 years. Sir, what will happen if the asset is sold? Don't worry, I'll teach you in some time. Deduction is allowed in every year starting from the year of commencement. Means once you start any of these listed businesses, in any year in future, you purchase any kind of capital asset, on that asset 100% will be allowed. Hotel business can be outsourced for operations. Means let's say for example, you invested in a hotel, you constructed a hotel, but operations you outsourced to someone to operate that hotel. That is absolutely fine, no problem. Now, always remember, whenever you purchase an asset, more than 10,000, if you make payment to a single person in a single day for purpose of that asset in more than 10,000 in other than prescribed modes, that value to the extent to which you made payment in cash or other than prescribed modes is not eligible for deduction, not eligible for depreciation. The same dialogue is given here also. So whenever you make payment for the asset for which you want to claim 35AD, you have to make payment through the prescribed modes only. What are prescribed modes? Account paid check, account paid demand draft, and electronic clearing system. And mind you, whenever if you sell the asset in future, this 35AD asset on which you claimed 100% deduction. If you sell the asset in future, the total sale value will be treated as business income only. And guys, in set off and carry forward of losses, you will read this section 35 AD losses. You can set off only against 35 AD income only. Now, sir, what will happen? Treatment if capital asset on which deduction under section 35 AD you claimed has been sold within 8 years. You told no, sir, there is a lock-in period of 8 years. What will happen, sir, if I sell the asset within 8 years? Then, if you sell the asset to outsider, means some other person you sold, then I told you sale value will become total Pgbp income. Total income it will become, and you have to pay tax on that. But if asset is transferred to other specified business, own business, let's say for example, you have one 2-star hotel and you have one hospital also having minimum 100 beds. Both are specified businesses only, no. So let's say for example, for a 2-star hotel which you have, you purchased one plant and machinery. That plant and machinery you transferred to your own hospital, which is again a specified business. Then there is no treatment, there is no impact on your income tax, because ultimately you are using within 8 years for the specified business only. Maybe you transfer to other specified business, but ultimately asset is being used for specified business only. So there is no treatment in that case. But let's say for example, if you transfer the asset to non-specified business within 8 years, then you are breaching the law. In that case, what will happen? Pgbp income will come. How much income will come? First, you will take the amount of cost of asset which you claimed as deduction under section 35 AD. From that, you will remove the notional depreciation. Means notional depreciation means for the period for which you use the asset for specified business, for that duration depreciation you will remove, and the net will be called as Pgbp income, which will be taxed in the hands of that person who claimed earlier the specified AD 35 AD deduction. If you transfer to non-specified business within 8 years, same just now I told you notional depreciation you have to remove. But if you transfer after 8 years, there is no problem after 8 years, because you have to just not sell within the lock-in period. After lock-in period you sell, there is no problem at all. There is no Pgbp, absolutely. Next, section 36, certain deductions. There are some miscellaneous expenses which are given as a deduction under section 36. The first one is insurance premium for stock in trade. So for your business stock in trade, you may have some insurance. If some fire accident happens and if the stock in trade gets spoiled, in that case you should have insured. So you are insuring your stock in trade. That is a business expenditure, and that is why it is allowed. Simple guys, always remember one dialogue in your Pgbp topic. If it is a business related expenditure, generally it is allowed unless it is specifically disallowed. Okay, next. Health insurance premium for employees allowed if premium is not paid in cash. So you took any health insurance premium for your employees, then whatever premium the business will pay for that will be allowed as deduction. Got it? Next. Animals used in business other than as a stock in trade. For dairy business, milk business, what is asset? The cattle is an asset. That animal which is used in business, for that, how to claim the deduction? How to claim the depreciation? Depreciation anyway not available. But mind you, once the animal will die or it becomes useless, it is not giving you milk anymore. In that case, whenever you will sell that cattle, that cow, in that case, you will get a deduction of the cost of animal when you purchased it, less the scrap value. Scrap value means the sale value. The difference will be claimed as deduction for your business. Now comes the bad debts. What is a bad debt? You sold some goods to someone, that person is not paying you amount, that is called bad debt. Mind you, in income tax, never claim provision as expenditure. In Pgbp, always actual expenditure only is eligible for expenditure or deduction. So bad debts, actual bad debts only allowed. Provision for bad debts are not allowed. In your accountancy, you might have deducted in your profit and loss account, but in the Pgbp, Provision for bad debts is not allowed, guys. Always remember this. Actual bad debts, if it is related to sale, only allowed. If it is related to loan, it is not allowed. So you gave loan to someone. Why would you allow it? Because that is a capital expenditure. That is a capital transaction. So it is not allowed. If your business itself is lending business, money lending business, then it is a business expenditure. You can claim it as actual bad debt. But generally, only bad debts related to sales only allowed, guys. Next. There is no need to prove that that debt is bad and all. And for claiming bad debts, assessee should actually write off, means actually there should be bad debt. Simple. Bad debt recovery. Let's say, for example, earlier years, there was a bad debt. But in future, that person came back to you and paid you the amount. That is called bad debt recovered. That bad debt recovery, it should be taxable in the year in which it is recovered. Got it? Next. Bonus and commission paid to employee, of course it will be allowed, but subject to 43B. We will read 43B in some time. Guys, in 43B it says that there are some expenditures which are listed under 43B. Those expenditures, payment has to be done on or before the due date of filing of return of income. And one such expenditure is bonus and commission to employee. So if you don't pay bonus and commission to employee before filing the return of income, you cannot claim it as business expenditure. Employer contribution to provident fund for benefit of employees. Guys, you know very well, there are two kinds of contribution. Employer contribution, employee contribution. What I am going to discuss here is employer contribution from his own pocket. So if employer contributes in statutory provident fund, recognized provident fund, approved gratuity fund, approved superannuation fund, and any fund as per law. See, mind you, these are all approved or statutory. In that case, they are allowed subject to section 43B. But mind you, if it is unrecognized, unapproved, they are not allowed, guys. Only approved, only allowed. And that too, employer contribution only I am talking here. For employer contribution, the payment shall be made on or before the date of filing of return of income under section 43B. This is regarding the provident fund contribution of employer. Mind you, guys, if it is an employee contribution, you cannot subject it to section 43B. You cannot say employee contribution, I will aram se pay before the date of filing of return of income. No, employee contribution should be paid before the due date of the respective fund's date. Next. Employer contribution to pension scheme under section 80 CCD or national pension scheme. Mind you, in this, employer contribution is allowed only to the extent of 14% of salary. And the salary definition here is basic plus dearness allowance in terms. And this is also subject to 43B. If the employer contribute more than 14% of salary, in that case, the excess contribution made by the employer will be disallowed in the books of accounts of the employer. So that's why actual contribution or 14% of salary, whichever is lower, is allowed as deduction. Employee contribution, very, very important. Employee contribution to PF, ESI, statutory, superannuation fund, etc. Guys, employee contribution has to be deposited by employer up to the due date of such fund. Means, let's say, for example, employer at the time of making salary payment to employee deducted the contribution of employee to the provident fund, but late deposited it. Means provident fund actual due date is 15th of subsequent month. Let's say, for example, May month salary, when the employer is making payment to employee, from the May month salary, employer deducted 10,000 of provident fund as employee contribution. So for May month, the due date is maximum 15th of June. The employer should deposit in the fund, but the employer did not deposit in the fund. He deposited later. In that case, whatever amount has been deducted by the employer from the employee's salary will become income of employer, and the employer has to pay tax on that. It is not allowed as deduction. Family planning expenditure of employee. A lot of times, especially this is allowed only in case of companies. Companies spend some money for promoting the family planning of the employees. In that case, if it is a revenue expenditure, 100% is allowed. If it is a capital expenditure, 1/5 it will be allowed in 5 equal installments. Mind you, family planning expenditure is allowed only in case of companies. It is not allowed in case of other than companies. Next, guys, if you want this handwritten notes, it is available on this website www.taxthalaiva.com. For all chapters, I have prepared beautiful handwritten notes. If you want, you can purchase. If you go under books tab under www.taxthalaiva.com, under books tab you will find handwritten notes. Only one product will be there for 999 rupees. You can purchase that. Now, discount on zero coupon bond. Lot of times zero coupon bond is issued. Zero coupon bond is issued at a discount, high discount, but later on at the time of maturity, at the face value it is remitted. In that case, whatever discount is there, that will be allowed in the hands of the company which is issuing the zero coupon bond on a pro rata basis, and that too based on calendar month. Now, interest on loan. Just give me a second. Just a minute. Interest on loan. If you take loan for business or profession purpose, it is allowed. But if you take loan for personal purpose, of course, that interest will not be allowed as your business expenditure because it is a personal expenditure. So if you take a loan for your business or profession, and if you take loan from banks or public financial institution or financial corporation or NBFCs, in that case, it is allowed subject to you make payment on or before the due date filing of return of income. So you have to make the payment of interest before filing return of income. If you do not make the payment of interest before filing return of income, then you cannot claim it as business expenditure. Actually, interest payment you should have made. If you took loan from others other than banks, a public financial institution, in that case, even if you pay or don't pay, both the cases it is allowed. But if you take any loans from banking institutions or NBFCs mentioned here, you have to make the payment on or before filing of return of income. Then comes the security transaction tax and commodity transaction tax. Guys, security transaction tax are generally paid at the time when you purchase shares or sell shares. This STT and CTT is allowed as deduction only if you are in the business of trading in securities. So if you are engaged in business of trading of securities or commodities, it is allowed as deduction. Now, remember guys, when I started this chapter, I told you section 30 till section 37, we will be discussing about all those expenses which we can claim as deduction. Now, we have discussed only till section 36. You know what? From section 30 till 36, every section has one specific nature of expenditure. Section 30, rent rates for building. Section 31, rates and taxes for repair, insurance for furniture, plant and machinery. Section 32, depreciation. Section 35, scientific research. Section 35, AD, specified business. Like this, every section has a specified nature of expenditure. If you incur any expenditure apart from section 30 to 36, any kind of expenditure you incur, all those expenditures you can claim it under this residual section, section 37. General deductions, all other expenditures. So section 30 to 36 are specific expenses, but under section 37 you can claim all other expenses, but provided these conditions are satisfied. First condition, everyone knows this. The expenditure should be wholly and exclusively incurred for business purpose. If it is a personal expenditure, of course, you will not allow. The next thing is the expenditure should be revenue nature. If it is capital nature, you will go and capitalize it and you will claim depreciation on that. And the expenditure should be a legal expenditure. Illegal expenses you cannot claim here. Now, following expenses are treated as illegal expenditures. Sir, what is an illegal expenditure? You are paying any bribe to any officer, that is an illegal expenditure, or you are giving some freebies to doctor. Means, let's say for example, you are one scanning center, x-ray scanning center, and you are paying to the doctors some fees. Sir, you refer here, even the patient is not even the patient is fully fine, you refer here, I'll share some commission to you. That kind of freebies. And if you have paid any kind of penalties for compounding any offense which you committed under any law, these are illegal expenditures. You cannot claim under section 37. Then what are the expenditures which we claim, sir? Say for example, you paid any salary to employees, that is allowed. Salary to working partner, allowed. But salary to sleeping partners is not allowed. This expenditure you cannot claim. And salary to any directors is allowed. Advertisement expenses allowed. But mind you, if you give any advertisement in a newspaper or a pamphlet or brochure of a political party, it is not allowed. In a political party, let's say for example, elections are going on. In Congress party or BJP party's pamphlet, you are giving advertisement. And for that you have spent money. That expenditure amount is not allowed. Diwali puja or any festival puja, Ramjan puja or Christmas puja, you want to do anything like that, and any office expenses you want to claim, you can claim here. Gift to employees or customers, you can claim here. Key man insurance policy premium, you can claim here under section 37. But mind you, CSR expenditure is not allowed. Corporate social responsibility is not a business expenditure. That is not allowed. Taxes. Guys, lot of times on this, the examination may test you. Always remember one thing. Any expenditure in the nature of income tax is not allowed. Only apart from income tax, any kind of taxes, municipal taxes, corporation taxes, goods and service taxes, customs duty, these are allowed. But income tax related expenses are not allowed. So, income tax including surcharge cess is not allowed, not allowed, not allowed. Even if it is a tax not allowed, interest also not allowed, penalty also not allowed. But GST and customs like indirect taxes, tax is allowed, interest also allowed, penalty is not allowed. Penalty, always remember guys, penalty for breach of law is not allowed, but penalty for breach of contract is allowed. Remember this section. This point you remember, penalty is never allowed under Income Tax Act, but if it is a penalty for breach of contract, it is allowed. Now mind you one thing, this GST, customs, whatever I told you, taxes are allowed, again subject to 43B. Don't worry, separately 43B I will be teaching you in some time. 43B is very simple. If you want to claim expenditure of those expenditures which are listed in 43B section, you have to make payment on or before the date of filing of return of income. Only then you will get the deduction. If you did not make the payment for the expenditure before filing return of income, you will not get the deduction. Penalty for breach of law is not allowed, but penalty for breach of contract is allowed. Next, other expenses. Like there may be some miscellaneous expenses like telephone expenses, printing and stationery, audit fee, traveling, any kind of expenditure. If it is for the purpose of business or profession, it is allowed. So what we have discussed so far is credit side. We have discussed the income, the list of incomes under section 28 we discussed, and we have discussed so far. And the debit side of your profit and loss account, right from section 30 till 37, what kind of expenses you can claim under the PGBP we have discussed so far. It is not ended yet. We have lot of provisions still which we need to cover under section 40 till 44. AD, ADA, AE we will cover now. Section 40, amount specifically disallowed. So far what we discussed, What is expenditure allowed, like that. Now we will discuss what are the expenses which are to be disallowed. Means these are expenses not allowed. What are those? First one is 40A1. Payment made to non-resident or foreign company. We'll take one example. Let's say, for example, there is a institute, coaching institute called as Thalaiva classes. Students requested, sir, please get one singer, sir, on our annual day. We will get Rema singer. He will come and sing a song. Baby, calm down, like that. We want that singer, sir. Beautiful, sir. He sings very beautifully. So I approached this non-resident. He is a non-resident. He is a foreigner, no, Rema. So we approached him for for singing a song, and we have to make payment to Rema for that. Let's say, for example, we made payment on 31st of December 2025. But we forgot to deduct the TDS while making payment to Rema. We did not deduct TDS. He is a professional, no. We did not deduct the TDS. TDS not deducted in previous year. TDS deducted or but not deposited within the filing of return of income. There may be two scenarios. Either I did not deduct TDS while making payment to Rema, or I deducted the TDS while making payment to Rema, but I did not deposit the TDS within the due date of filing of return of income. There may be two scenarios. In that case, whatever amount I paid to Rema, I cannot claim it as business expenditure. 100% of such expenses will be disallowed in the previous year 25-26. Sir, what if, sir, later on you went and deposited the TDS with the government? In that case, if TDS is deposited, let's say, for example, on 7th of Jan, then expenses allowed in which previous year? This is falling in previous year 25-26. In that previous year, I can claim it as deduction expenditure. 100% I can claim. If I deposited the TDS in 19 November 2026, then I can claim in previous year 26-27. But if I claim if I deposited the TDS on 15th of March 2027, then I will claim the expenditure in 26-27. But if I deposit in 15th of May 2027, I will claim it as deduction in 27-28, the payment which I made to Rema. So any payment made to non-resident without deducting TDS, or after deducting TDS but not deposited the TDS within the due date of filing of return of income, 100% of the expenditure will be disallowed. Nothing will be allowed. But you can claim the expenditure in the year in which you will deposit the TDS with the government. But if you make any payment to a resident and you did not deduct the TDS, in that case, only 30% of expenditure will be disallowed. 70% you can allow. Let's say, for example, Thalaiva classes. Students requested, sir, Rashmika Mandana is very beautiful. She dances really well, sir. Can we call her for our annual day celebrations? So I approached Rashmika Mandana and I told her, madam, please come for our annual day and you dance, madam. We will pay you this much of amount. And when I made the payment to Rashmika Mandana, either I did not deduct the TDS or I deducted the TDS but did not deposit with the government. In that case, of course, 30% of expenditure which I want to claim in my books of accounts as annual day expenses, I cannot claim up to the extent of 30%. So I made the payment on 31st of December 2025. But let's say, for example, I deposited TDS on 7th of Jan 2026. It is well within the year only. So 25-26 itself, I will allow the expenditure. Earlier disallowed amount of 30% is allowed in which previous year? So earlier 30% of expenditure is disallowed. But now when I will deposit on this date, I can claim the 30% earlier disallowed. Now I can claim it as expenditure in previous year 25-26. So if I deposit the TDS on 19 November 2026, I can claim it in previous year 26-27. If I deposit in 15th of March 2027, I can claim that 30% earlier disallowed. Now I can claim that 30% in 26-27. If I deposit on 15th of 15th of May 2027, I can claim it in previous year 27-28. Got it? Now, there is one common note for 40A1 and 40A1A. if TDS is deducted in subsequent previous year, means these scenarios. In that case, you can claim that earlier disallowed 100% or 30% as TDS of that TDS in the previous year in which you deposited the TDS. Next, exception to 40A and 1A. There is one scenario in which you did not deduct the TDS, or you deducted the TDS but that did not deposit. But there is one case in which this allowance will not be attracted. What is that case? If any amount paid or credited but TDS not deducted, but payee means the person who received amount from you has offered such income to tax and has paid tax on such income to the government and filed his return of income and has furnished a certificate from a chartered accountant to you in form 26A. In that case, this allowance will not be attracted. Got it? Next, 40A3. TDS on salary payment outside India or to a non-resident in India. Always remember, whenever you make any salary payment to outside India or to a non-resident in India, you have to strictly follow the TDS provisions. Even if a single day if you miss, gone. In lifetime you will not get the deduction. Even if you go and deposit the TDS late. Any salary paid outside India or to a non-resident, if TDS is not deducted or you deducted but not deposited, in that case, salary will be totally disallowed and never be allowed again, even if you deposit the TDS late. If TDS deposited late even by 1 day, guys, salary is not allowed for lifetime. Next, tax on non-monetary perquisite of employee. You know, non-monetary perquisites in salary chapter we discussed. If an employer himself pays tax on the non-monetary perquisite of employee, that is not allowed as deduction in the hands of employer, because the tax actually belongs to employee. Employee should pay the tax. Now we will move on to next section, 40A2, payment to relatives. Guys, if you make any excess payment to relative or unreasonable payments to relative, that is totally disallowed. Let's take one example. Let's say, for example, there is one coaching institute, Thalaiva classes. And there is one lady called as Thalaivi, wife of Thalaiva. So Thalaiva is owner of this Thalaiva classes and Thalaivi is wife of Thalaiva. She is not qualified for any job. She is illiterate, for example. But Thalaiva classes is paying 5 lakh rupees per month as salary to Thalaivi, in which reasonable is only to the extent of 6,000 per month. Unreasonable is 4,94,000 per month. So unreasonable expenditure is disallowed in the hands of Thalaiva classes, but only 6,000 which is reasonable to that extent is allowed in the hands of Thalaiva classes. If any payment made to relative, then assessing officer can disallow excess or unreasonable amount of expenditure. Sir, who is relative? It is given here. You can read it later. Now, section 40A3. Guys, remember one thing. If you want to claim any kind of a business expenditure, you should make the payment for such a business expenditure through the prescribed modes of payment only. If you made for a particular expenditure payment to the seller or vendor to a single person in a single day, more than 10,000 in cash or other than in prescribed modes, in that case, to the extent which you made the payment in cash modes or other than prescribed modes will be disallowed. You cannot claim the expenditure. The limit of 10,000 will become 35,000 limit, higher limit in case if you make the payment to a goods transport agency. So if you make any cash payment more than 10,000 to a single person in a single day, sir, only cash is covered, sir. Only cash, sir. If I make payment in bearer check, not allowed. Cross check, not allowed. But you have to make payment in account pay check or account pay demand draft or electronic clearing system. These three are allowed, but these three are not allowed. Mind you, in a single day to a single person more than 10,000. We will take some examples. Let's say, for example, Thalaiva Classes is a coaching institute. It wants to print books. Thalaiva books it wants to print. So it engaged or it got into contract with the two printers. One is Samantha Printers, the other is Nainatara Printers. To Samantha Printers, Thalaiva Classes made payment of 9,000 in cash. Is it allowed? Yes, because to a single person in a single day, you made payment up to 10,000 in cash is allowed. No problem. It is allowed as expenditure. Nainatara Printers, you made payment of 10,000 in cash. Is it allowed? Yes, up to 10,000 it is allowed. No problem. More than 10,000 not allowed. Next example. Thalaiva Classes made payment to one single vendor, Samantha Printers, on a single day, 19th December, morning 9,000 cash, evening 8,000 cash. Now, mind you, to a single person in a single day, you made payment more than 10,000 in cash. Total 17,000 is disallowed, not allowed as business expenditure for Thalaiva Classes. One more example. Thalaiva Classes made payment to Samantha Printers on different dates. Now, mind you, we have to check what? Single person, single day we have to check, not all days put together. So, in single day, 9,000 cash payments. These are all cash payments. Is it allowed? Yes, it is allowed. Less than 10,000. On a different date, 10,000 allowed? Yes, exactly 10,000 allowed. More than 10,000 not allowed. Again 8,000 allowed. Again 7,000 allowed. None of the payments are more than 10,000. Everything is allowed. One more example. Thalaiva Classes made payment to Tata Transporters. Tata Bye-Bye Transporters. Transporters, good transporters. Means I told that transporter, my books are ready. You please get it to my office. So the goods transport company will go in one truck. They'll put all the books and get to my coaching institute. I have to make the payment. In that case, up to 35,000, mind you, I can make payment in other than prescribed modes. In 29 December, I made morning 20,000 cash, 5,000 cash I made at the evening. Total in a single day, I made only 25,000 in cash. No problem, fully allowed. Because for goods transport, the limit is 35,000. One more example we will take. Let's say, for example, Thalaiva Classes purchased pens from Papa Pen Shops. Papa Pen Shops, there is one pen shop. And Thalaiva Classes purchased pens on credit. Means cash is not paid. On credit basis, you purchased 5 lakhs worth of pens to distribute to the students. In previous year 23-24, I purchased. Now, when I purchase goods on credit, I can claim it on expenditure in that year. There is no restriction. It is not subject to 43B. So I will claim this 5 lakhs as my business expenditure. Even though I have not paid it actually. So in previous year 23-24, I claimed it as expenditure. See, in previous year 23-24, in P&L account on accrual basis, I claimed as expenditure. 2 purchases, 5 lakhs allowed. Okay. Purchases or any kind of expenditure you can book. Now, but when I made the payment of 5 lakhs in future to this Papa Pen Shop, in previous year 25-26, I made the payment other than in cash, other than in prescribed modes. In that case, disallow 5 lakhs in the hands of Thalaiva Classes in previous year 25-26 because the payments were not made in prescribed modes. If I made the payment in prescribed modes, then no problem, no disallowance will happen. Next, Thalaiva tips for section 40A3. Same, whatever I told you here, in a single day, single person, more than 10,000, transporter 35,000. And if you take the expenditure, earlier you claimed the expenditure on credit basis and in subsequent year you paid in cash, in that case, whatever deduction you claimed earlier shall be withdrawn, means disallowed, and you have to pay tax and it will be taxable in the year in which payment is made. Got it? Next, rule 6DD. Guys, there are certain scenarios in which even though you make payment to a single person in a single day more than 10,000 in other than prescribed means even if you make cash payment more than 10,000 to a single person in a single day, still it will be allowed. So cases in which cash payment can be made more than 10,000. What are these, sir? This is called exception to section 40A3, rule 6DD it is. This is the list of transactions. if you make any repayment of loan payment, or if you are making any payment to commission agents, or you are making any payment to banks or LIC or credit society or any government entity, or you are just making a book adjustment entry, or you are making any payment for purchase of any agriculture produce or animal husbandry, or you are purchasing anything, you are making any payment to any cottage industry where they work on a manual basis, or you are transacting in a village or a town where there is no banking facilities, or you are making payment for any retirement benefits up to 50,000 rupees, or you are posted, one employee is posted in a temporary basis in any area, and for that payment of salary is to be done maximum for 15 days. In that case also you can make a cash payment. And in case of foreign exchange dealer, of course they deal in cash, so there also you can make payment more than 10,000 in other than prescribed modes, no problem, you make in cash payment more than 10,000, it is allowed. These are exceptions to rule 6DD. Just have a look once and go for examination. Now comes section 40A7, provision of gratuity not allowed. I told you already, any kind of provision is not allowed under Income Tax Act. So provision for gratuity not allowed, but if you actually paid any gratuity amount, it is allowed. Contribution to approved gratuity fund, actual payment basis, it is allowed. The provision is not allowed. Now, at multiple places we have seen section 43B, 43B, 43B. What is 43B? Very simple. In 43B, there are some list of expenditures given. In these expenditures, you have to make payment before filing the return of income. All other expenditures, if you are following accrual basis of accounting, even if it is payable, still you can claim it as expenditure. But there are some list of expenditures given under section 43B, which you have to actually make the payment in order to claim it as deduction. Before filing the return of income, you have to make the payments. Expenses allowed only on payment basis. The first one is bonus and commission to employees. We read already. Any taxes, we read this also, indirect taxes. Employer contribution to PF, we already read this, covered. Interest on loan also we covered. Leave salary, leave encashment, and any payment to Indian Railways for use of any railway assets. These are the expenditures which you have to make payment must before filing return of income. Only then you are eligible to claim the deduction under section 43B. Otherwise it will be disallowed. Now, lot of times this is asked in examination. Payments to micro and small enterprises. Mind you, here medium enterprise is not covered. Only payments to micro or small enterprise is covered. Guys, let's take one example. Thalaiva classes is making payment to micro or small enterprise for purchase of any goods or services, for example. Now, payment to MSE shall be made as per section 15 of MSME Act. What is given in MSME Act? If there is an agreement between Thalaiva classes and this MSE enterprise, then the payment shall be done maximum within 45 days. If there is no agreement made, then the payment shall be done maximum within 15 days, mind you. Are you getting it? Next. What is a MSE, sir? How will I find out, sir, whether the vendor is a MSE or not? If the investment in plant and machinery or equipment of the enterprise is up to 2.5 crores and turnover is up to 10 crores, then it is a micro enterprise. But if the investment in plant and machinery is up to 25 crores and the turnover, if it is up to 100 crores, it is a small enterprise. These are the enterprises to which if you make any payment for any goods or services taken from these enterprises, you have to make payment within 45 days if there is agreement, and within 15 days if there is no agreement. Sir, what will happen if I make payment after 45 days or 15 days? Then whatever expenditure you spent, whatever amounts you are making payment to this MSE enterprise is not allowed as deduction. It will be totally disallowed under section 43BH. Got it? If payment done within the time limit, then allowed in the current previous year of purchase. If payment is done beyond the time limit, then allowed in the year in which actual payment is done. But in the year in which you did not make the payment within 45 days or 15 days, it will be disallowed. In my Thalaiva notes, one example is given. Go and check. It will be much clarity for you. Now, the above provision is not applicable for medium enterprise. This just now I told you. The next one is 43A, asset acquired from foreign country. Lot of times what happens? Let's say for example, I am buying one plant and machinery, one asset I am acquiring from foreign country. Now, if I purchase any asset from foreign country, then I have to make payment in foreign currency. Correct? Because the invoice will be in foreign currency. Now, whenever, let's say for example, first I purchased an asset on credit basis for five or $1 lakh, $1 lakh. Now, as per $1 lakh, I will first capitalize the asset in my books of accounts. $1 lakh into 95 rupees per dollar, let's say for example. So 95 lakhs of worth of asset, I put it in my block of asset. Now, whenever I will make the actual payment of this $1 lakh, the dollar rate will fluctuate. If the dollar is strong, I will lose more money I have to pay to the vendor. If the dollar is weak or the rupee is strong, I have to pay less, so I will gain. So if there is a forex gain, always remember, reduce that amount of gain from the block of asset. If there is a foreign exchange loss, then add it to the block of asset, because that is adding to the cost of asset and you can claim depreciation on. Next, section 41, deemed income. If you remember, when we started the topic on the credit side of profit and loss account, I wrote only two sections, section 28 and section 41. Section 28 were actual incomes, but section 41 is deemed income. These are not actually incomes of a business, but these are actually deemed as income of a business, and you have to pay tax on this. So first one is section 41.1, recovery of any deductions claimed earlier. Let's say for example, GST refund. Earlier you claimed GST as expenditure, but you got a GST refund later. That is an income, deemed income. Seller of goods waived off credit. First, you debited your profit and loss account to purchases 1 lakh rupees like that. But the seller of the goods told, okay, you don't pay anything. Then you unnecessarily claimed that expenditure. You are not making any kind of payment to that. Then you have to reverse it. That will become income for you. Working capital loan waived off by banks. A lot of times, working capital loan you will take from bank and the bank will waive off under some government scheme. If that is the case, in that case, you will credit it to the profit and loss account as income under section 41.1. 41.1 to 14 already covered earlier, guys. Balancing charge and bad debts recovery is already considered. Now, 41.3, sale of scientific research asset. Guys, you know very well, scientific research asset, if you purchase, you are eligible for 100% deduction under section 35. Of course, you are not eligible for depreciation. But what will happen if you sell this asset in future? If you sell the asset without putting to use in the business, and if the sale price is less than the cost, then the sale price or deduction what you claimed earlier, whichever is lower, you will have to offer it to tax under section 43.1, 41.3 under Pgbp. Sale after use in business. If you sell the asset after putting use the business, then of course add to block nil, but sale price section 50 shall apply. But if the sale price is more than cost, anytime you will get a capital gain. Now we will talk about the tax audit section 44AB. Tax audit for persons carrying on business or profession. Guys, what is the tax audit? The books of accounts which you prepared as per the Pgbp, as per the income tax, whether it is correct or not, one auditor will check. That is called a tax audit. This may be happening in case of specified professions or businesses. We will discuss this 44AD separately, don't worry. So if you are in a profession and if your gross receipts are more than 50 lakhs, you are required to get your books of accounts audited. And if you are into some business and if your turnover is more than 1 crore, you are required to get your books of accounts audited. But this 1 crore limit will become 10 crores only if the cash receipts and cash payments of your business both are less than or equal to 5%. Means 95% or more of your business transactions, both receipts and payments should be through the prescribed modes, through the banking channels. Only then you will be enjoying the benefit of 10 crores of limit. And mind you, when I say the banking channels, it means payment received in cash or DD is not, check or DD which is not account pay shall be treated as cash. This I already taught you. Account pay check, account pay demand draft it should be. It should not be bearer check and bearer DD, demand draft. And penalty will also be applicable if you do not get your books of accounts audited. Lower of 0.5% of turnover and 1,50,000, whichever is lower, will be levied as penalty. Now we will discuss three sections which are 44 AD, ADA, AE, presumptive basis of income for businesses and professions. Guys, under 44 AD, presumptive basis of income for business. Let's say, for example, you are a businessman. Small business people, this is actually applicable. If you are an individual or an HF or a firm but excluding LLP, if you are any of these taxpayers and you have a business, but the business should not be any profession or brokerage business or commission business or agency business or transport business. And if your turnover is up to 2 crore rupees, then you know what? Government says you don't maintain any books of accounts. You don't get your books of accounts audited, nothing. You just offer me either 6% of turnover or 8% of turnover, enough. If your turnover is up to 2 crore rupees, you offer me 8% of your turnover as your profit. Under Pgbp head, I will not ask you books of accounts. I will not ask you to get your books of accounts audited. I will assume, I'll presume that 8% is your profit. That's all. And mind you, this 8% also you can further less, 6% only you can offer, provided only to the sales on which you have realized through account paycheck, DD, or through electronic clearing system. Let's say, for example, we'll take one example. Let's say, for example, your turnover is 1 crore 80 lakh rupees. Out of 1 crore 80 lakh rupees, 60 lakhs you have realized in cash, and rest 1 crore 20 lakhs, 1.2 crores you realized through banking channels out of sales. So on this 60 lakhs, you have to offer 8% as profit. On this 1.2 crores, you have to offer 6% as profit. Then enough. No need to maintain books of account, nothing. That is called presumptive income. So whatever 6%, 8% we will calculate, that will be treated, that will be assumed as your Pgbp. That's all. Then further, you are not eligible for any kind of expenditures, not even depreciation. And this 2 crores limit, you can increase it to 3 crores provided the transactions in your business more than 95% should be through electronic clearing systems, prescribed modes of payments. So higher limit of 3 crores you can enjoy if cash turnover is up to 5% only. So up to 5% you can do it in other than prescribed modes, but more than 95% of your transactions should be through the prescribed modes of payments. So if assessee offers minimum that 6%, 8%, no need to maintain books, no need to get the books of accounts audited. If assessee turnover is less than 2% or less than 2 crores or 3 crores, and sir, what if, sir, I don't want to pay 8%, 6%, sir. If my turnover is up to 2 crores, 3 crores, I don't want, because my business actually do not give me so much of profit. Why should I, offer 8% or 6%? I want to offer less, sir. Then you can offer less, but you have to then maintain books of accounts and get them audited also. So if assessee's turnover is less than 2 crores or 3 crores and wants to offer less than 8% or 6%, then it is must to maintain books of accounts and get them audited. But mind you, this you will do only if the total income of your year, in a year, if your total income is exceeding basic exemption limit. Now there is one very important point. If you want to opt for 44 AD, once you opt, then for another 5 years you have to offer under 44 AD only. If naturally your turnover is exceeding 3 crores, that is a different case. But if your turnover is well within 2 crores or 3 crores only, in that case, once you opt, let's say for example, in this year, you are offering to tax under 44 AD. In that case, Another 5 years you have to offer under 44 AD only. If by chance in any of these 5 years you are going out of a 44 AD presumptive case, in that case another 5 years you can never pay tax under 44 AD, mind it. Got it? Next. 44 ADA presumptive PGBP for professions. For 44 AD is for business, ADA is for professionals. This is applicable in case of resident individuals and firms other than LLPs. HUF is not covered here because HUF can never have a profession. Engaged in notified professions. If the gross receipt is up to 50 lakhs, straight away 50% of your gross receipt you can offer it as PGBP income. No need to maintain books of accounts, no need to get your books of accounts audited. And this 50 lakhs you can claim a higher limit of 75 lakhs if more than 95% of your transactions are happening through prescribed mode of payments. Next one is 44 AE. Presumptive basis of income in case of flying, hiring, leasing of goods carriage businesses. You know, small transporters will be there. They'll be having one trucks, mini trucks like that. So they can actually avail this 44 AE business. This is also business only. 44 AE benefit they can avail. Now what is 44 AE? If you are a business of goods carriage business, if you have, and if you are owning only up to not more than 10 goods vehicle during any time during the year, in that case you can offer this presumptive income and the government will accept it. What is this? For a heavy good vehicle you have to offer minimum 1000 rupees per ton of gross vehicle weight or unladen weight for each month. So 1000 rupees per ton for each month you have to offer. Now how will you know, sir, whether it is a heavy good vehicle or a light good vehicle? You have to check. Heavy good vehicle means exceeding 12,000 kgs the gross vehicle weight, and if the vehicle weight is less than 12,000 it is a light vehicle weight. And if it is the other vehicle, means other than a heavy good vehicle, you have to offer straight away 7,000 rupees, 7,500 rupees per vehicle per month. This is per vehicle per month. This much if you offer, good enough. No need to maintain any books of accounts. No need to get books of accounts audited. The next section is 40B. Guys, you remember, in case of partnership firms, partner will get capital into the business. He will expect two things from the partnership firm generally. One is interest on capital. The other thing he will expect is remuneration. Remuneration may be salary, bonus, commission, whatever we call. Now, in the profit and loss account of partnership firm, whether how much ever interest will be paid to the partner is allowed, how much ever remuneration paid to the partner is allowed or not is a question mark. There is nothing like that. There is actually limit prescribed in the Income Tax Act. Means in the profit and loss account of a partnership firm, the partnership firm can claim only to certain extent as expenditure of interest paid to partner on partner's capital, or remuneration paid to partner only to certain limit only is allowed as expenditure in the books of accounts of partnership firm. If the partnership firm pay anything beyond the limit, then the excess will be disallowed in the hands of partnership firm. Got it? So following amounts shall be disallowed in the hands of partnership firm or LLP. Any payment made to non-working partner. Guys, to non-working partner, any payment you make, any amount you make, it is disallowed. Only working partner, if you make any salary payments or interest payments, it is allowed. Number one, unauthorized payments to working partner. Let's say, for example, in the partnership deed, it is not authorized to make any payment. A certain payment is not authorized by the partnership deed, then also it is not allowed. Third, any payment before the date of partnership deed. Let's say, for example, you started your partnership firm on 15th of, let's say, for example, you started your partnership firm on 15th of June 2025. But you created a deed on 15th of September 2025, for example. Now, whatever payment you started the firm on June, but you created the deed on 15th of September. So whatever payments you will make in this duration is not allowable as expenditure. So any payments made before the date of partnership deed is not allowed. And interest on partner capital or loan exceeding 12% is also not allowed. So if you make any interest payment to partner exceeding 12% per annum, it is not allowed. Let's say, for example, firm pays 16% per annum as interest on capital contribution of partner. Only 12% is allowed. 4% excess interest is totally disallowed. Now, when it comes to interest payment, guys, lot of times partner would be representing another entity in the partnership firm. Let's say, for example, HUF. HUF is a partner, but partner is Kartano. In that case, what will happen? If partner is on individual capacity, means he is not representing any HUF, he is only partner. Let's say, for example, me, I am only partner in a partnership firm, and if I receive any interest in that case, I am receiving the interest on individual capacity. In that case, maximum 12% only interest allowed, because I am a partner, I am receiving interest from the partnership firm. But if I being a representative capacity, let's say, for example, I am actually representing partnership firm, my HUF in the partnership firm. My HUF is a partner in the partnership firm. I am not the partner, I am just a karta, but I am receiving interest on representative capacity, then also 12% interest only maximum allowed. If I am partner on an individual capacity, I am only partner, but I am receiving interest in representative capacity. Means actually loan is given by HUF to the partnership firm. I am receiving interest. I am not receiving interest. The HUF is receiving the interest from the partnership firm. Then limit is not applicable. And if I am partner on a representative capacity, but I am receiving interest on an individual capacity. Let's say, for example, I am a karta of HUF, but I personally gave loan to the partnership firm. HUF is partner in the partnership firm. Then whatever interest I will receive, that will not be triggered by the limit of 12%. Very simple. In examination, if you don't want to get confused, simple remember, if both are same here, then only limit is triggered. Limit is cap of 12% is applicable. If you see here, both are different. Here individual capacity, representative capacity, individual capacity, then the limit will not be applicable. Remember like this in examination. Now, whatever I told you, 12% is applicable only for interest on capital contribution or loan paid to partner, 12% maximum allowed. But whenever a remuneration is paid to a partner, there is a limit. Up to that limit only it is allowed in the books of accounts of partnership firm. What is the limit, sir? Remuneration to working partner only, mind you, non-working partner, it is not allowed even a single rupee. In excess of below prescribed limit, even if authorized by deed. Even if the partnership deed says, or even if the partnership deed is authorizing more payment, still Income Tax Act will not allow. What is that? First, you have to take a book profit. What is a book profit? Profit as per Pgbp before deducting remuneration, but after deducting all the expenditures. Guys, book profit is nothing but you have to take the Pgbp profit of a partnership firm. After claiming all deductions, including the interest within the limit, whatever is there, you claim all the deductions except the remuneration for which we are calculating here. That is called book profit. On first 6 lakhs of book profit, or in case of loss also, you have to take higher of 3 lakhs or 90% of book profit. Higher you will take. And on the remaining balance book profit, you will take 60%. This is the limit up to which maximum you can pay remuneration to partner. Remuneration includes salary, bonus, commission, everything. We'll take one example. Let's say, for example, 11 lakhs is the book profit. Remuneration actually paid to the partner is 9,50,000. Now, how much disallowance will be attracted? Simple. Book profit is 11 lakhs. So, on first 6 lakhs, you have to take 3 lakhs or 90% of 6 lakhs. That will be 5 lakh 40 or 3 lakhs. Whichever is higher is 5 lakh 40. Now, on the balance of 11 lakhs minus 6 lakhs, on the balance is what? 5 lakhs. Into 60%, 3 lakhs. So, 540 plus 3 lakhs will be 8 lakh 40. This is the maximum salary or remuneration which you can pay to the partner. But how much is paid? 9,50,000 is paid. So how much disallowance will come? 9,50,000 minus 8,40,000, 11 lakh, 1,10,000 is a disallowed and firm has to pay tax on that. Got it? Next. Remember this, very, very important. Guys, I'm just now I told you interest maximum 12% is allowed in the hands of partnership firm, and remuneration also only to this extent it is allowed. Now, everyone will focus here. Guys, totally 9,50,000 is paid to the partner as remuneration. So in the partner's hand, 9,50,000 is income. Now, actually on 9,50,000, if it is income, under which head it will go in the hands of partner? Pgbp head. Now, if 9,50,000 is taxable under Pgbp, then it will become double taxation, because here 1,10,000 is getting taxed in the hands of partnership firm, and this 1,10,000 is nothing but forming part of 9,50,000 only, no. And that's why this 8,40,000, whichever is allowable in the hands of partnership firm, it is allowable means firm is not paying tax on that. So 8,40,000, on this 8,40,000 the partner will pay tax, and on this 1,10,000 the firm will pay tax. Means to the extent to which 8,40,000 is allowed in the hands of partnership firm, partner will pay tax. And to the extent to which it is disallowed in the hands of partnership firm will pay tax, and it will be exempt in the hands of partner. Same thing. See, partnership firm is paying remuneration to partner, remuneration or interest. If it is paid within the limit, then it will be allowed as deduction under 40B no in the hands of firm, and it will be taxable in the hands of Pgbp. Because see guys, if it is allowed as deduction in the hands of partnership firm, then tax is not paid in the hands of partnership firm. Then who has to pay tax? Then it is paid tax, the partner will pay tax. But let's say for example, if the remuneration or interest is paid in excess of 40B, then disallowance will happen in the hands of partnership firm. Means the disallowance happening in the partnership firm means partnership firm already paid tax on that. In that case, it will be exempt in the hands of partner. Any one only will pay tax. So if it is disallowed in the hands of partnership firm is paying tax on that amount, then it should be exempt in the hands of partner. If partnership firm is not paying tax on the remuneration or interest, means it is totally allowed, then the partner will pay tax on the amount which he is receiving from the partnership firm. Now, there are some miscellaneous things, two things, and then we will close it. Guys, under section 140Y1, it says that method of accounting. Whenever you compute your Pgbp income or IFRS income, you can either follow cash method of accounting or accrual system of accounting, guys. Anything you can follow. Now, there is something called as speculative business in your Pgbp. Speculation means very simple, guys. You bet on the price. There is no actual delivery. Let's say, for example, you book 100 kgs of gold. Actually, you are not getting 100 kgs of gold here, but you are just booking the 100 kg of gold virtually at a particular price, and virtually you will sell that. Let's say for example, today you purchased 100 kgs of gold at 1,000 rupees per kg, like that, and you sold it for 1,200 per rupees per kg. So 200 is your profit. You will get the profit, that's all. You will not even pay that 1,000 kgs of gold price. Neither they will pay you 1,002 or that 1,000 kgs at the time of sale. It is just a virtual transaction. There is no actual delivery. That is called speculation. You are just speculating the price. In that case, it means a transaction in which contract for sale or purchase is ultimately settled by otherwise than actual delivery. There is no actual delivery. But there are some transactions not regarded as speculation business. Guys, you have to remember these three things, because in examination, in set off carry forward of losses, speculation loss can only be set off with speculation business. In that case, you need to understand these three are not speculation businesses. Hedging contract, forward contract, and derivatives, any kind of futures and options are not speculation business. Speculation business and normal business are treated as separate businesses. Always remember this, guys. And that is the end of our Pgbp discussion. Guys, if you genuinely think my teaching is helping you, write in comment section whatever you want to write. That will give me boost my confidence for the energy and the time which I have spent. And hit one like button and share with your friends regarding these amazing sessions which we are providing to you. And please do subscribe to my channel if you are new to my channel for this kind of amazing content. Before your examination, I will be coming up with lot of expected questions, super questions, super 50 adjustments, like this many things I'll be coming up with. And as I told you, if you want to download the Thalaiva Notes, Thalaiva question bank, it is available in this video's description. You can definitely go and download that, or you can visit www.taxthalaiva.com under free resources. Anyway, you will find there also. If you want regular class, or you want practice batch, it is available on my website www.taxthalaiva.com, or you can purchase it from CA Classroom. If you want income tax and GST combo, or you want full group 1 combo, like that, if you want to buy, you can go to www.caclassroom.com, which is owned by Karthik Manikonda sir, and we have officially collaborated. So if you have officially collaborated, you can buy my product there also, or on my website. There you can create combos. There are Amit Mahajan sir and a lot of ANM sir, Kaushik Mukesh sir. There are lot of options available for your GST also. You can go and buy from there. You can create a combo. You want only group 1, that is also possible. Everything is possible. You can buy it from there also. Okay guys, we'll see you in the next topic.